Welcome to the Telltales Podcast, where we discuss cash flow and its pivotal role in investing. I'm Mike Nicoletti.
And I'm Jason Wallace. Along with our co-host Hunt Lawrence, aka Mr. Cashflow, we're here to explore how cash flow drives the economy and investment performance.
And don't forget to join our email list at telltales.us to get the cash flow memo. It's about 20 pages covering 80 companies, the U.S. government's finances, and the energy sector.
It's like having a masterclass on investing in your inbox every week.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
I have a new way of thinking about Exhibit C. I'll be interested in how Mike and Jason react to this, and everyone. I think that since there's surplus capacity of at least 4 million barrels, maybe 5, and since demand is only growing by about 1 million or 1,200,000 or 1,300,000 barrels, I think that the price for oil without a political risk premium would be around $60. Instead, WTI has been around 80. So that would mean a risk premium of $20, risk premium being caused by the situation in Gaza and the situation in the Ukraine and the Houthis blocking the Red Sea or approaches to the Suez Canal, and the possibility of Israel and Iran sending missiles at each other, or the Houthis sending missiles at the Saudi oil facilities. All the above, let's call it $20. When we look at the news feed for the last bit of time and try to project ahead a couple of weeks, I think that risk premium is vulnerable. In other words, I think that it's more likely rather than less likely in a week's time or a month's time, risk premium will be less. So if your own oil companies or companies that produce oil, I think the right answer is sit tight. If you've been meaning to add a position or add to a position you already have or start a new position, I think at this point, the thing to do is to cool it for the next 3 or 4 weeks and see what happens to that $20 risk premium. We turn to Exhibit B on gas supply. Similar situation. These are new numbers, and the LNG feed gas has been curtailed a bit, and it probably means here that the problem is supply, dry gas production, which has been going up faster than LNG demand has been going up, and faster than power demand. Now, the tricky part of this is power demand was flat as a board until 21, and then it went up by 2 Bs a day in 22, 1.5 in 23, and this chart has it going up 1.5 in 24. The problem with that is we're now through 4 months, and LNG demand is not going up. So we're totally dependent on the price of gas getting back into a reasonable range, say 3.5 on supply. Now, the question is, if this is kind of different, a risk premium, it's what gas price is necessary to beat the decline curve and add significant amounts of supply. If we look down at the average price for Henry Hub, in 2019, it was $270. In 2020, it was $220. 220, of course, was the COVID year, the first year, the 2 years of COVID. It bounced to $370 in 21 and was $6 in 22. So there was a lot of increase in supply in 21, 22, and into 23. Question is, what happens now at 275 average last year, at 280 or so average this year? Hopefully the supply slows down, but we can't know that. Once again, gas prices for companies reflect at least $3. So if you own a position in a gas company, EQT, Antero, Chesapeake, some of the better gas companies, I think you sit with it. If you're thinking about adding to it, just cool it. Probably more than a month, probably a couple of months. And if you're looking to start a position, once again, defer. Almost all the people on the phone are U.S. citizens, U.S. taxpayers. Exhibit A means that our taxes are likely to go up. Biden administration says no one's taxes will go up who earns less than $400,000. I don't know whether that is going to be possible in the second Biden administration if he wins on November 5th. Trump will run on his record of having taxes decline during his administration. For us people in California and New York, they didn't really decline because we lost the state income tax deduction. I don't think it's possible to predict that Trump will win or Biden will win, but I think it is possible to and likely that taxes will be higher 4 years from now than they are now. It doesn't really impact the investments you make, except for this, that if you can find companies that you can buy and stay in, your only tax is if they pay a dividend. You don't get taxed on the capital gains until you sell. So if you want to increase your net worth, if you can be careful and attentive and find some things that you can hold for 10 years and they go up, let's say they make our standard, which is try to double your investable assets, the value of your investable assets every 5 years, that's a 15% return. Most people would gladly settle at this point with fairly elevated stock market values and some uncertainty with interest rates and who's going to win the election in November. Most people would settle for a 15% return for the next 5 years. So great advantage. There's 60 companies, I think, on these 20 pages. If you already own or can find companies that you're comfortable, have a 5 or 10 year horizon in front of them, so that you won't have to sell. That's one way to cope with taxes. That I'm going to stand down. And Jason, you're the furthest away calling in from Mexico. Any commentary on those points?
Nothing to add from me.
Mike, I guess it's your turn.
When it comes to presidential election, and this is something taken away from the Buffett meeting or the Berkshire Hathaway meeting the other day. Remember a story about Warren Buffett referring to a wonderful company is one that can be run by a ham sandwich. And after the Buffett meeting, Jason and I kind of talking about this, said, well, maybe the great thing about the United States is that it can be run by a ham sandwich. So just when it comes to you'll be inundated with all sorts of political stuff in the next couple months. And maybe the thing to remember is no matter what happens, the system is set up so that it can be run by a ham sandwich.
That's great. I don't see how we can not talk for the third Wednesday in a row about Tesla. This is just so interesting. Musk has given a talk at the Milken conference. It just illustrates what you're dealing with if you're a Tesla investor. Very, very broad gauge. Is sure in any 10-minute discussion to mention colonizing Mars. I mean, he really believes in that. But the interesting thing about the snippets of the conversation of the Q&A period that I've heard is his take on artificial intelligence. And I guess it's along the line of being serious about colonizing Mars, but he actually believes that artificial intelligence will take some kind of primacy over human intelligence, and quotes, science fiction writers and movies and whatnot, or illustrations of what he thinks is the future looks like. Now, that is to the extent that his views are influential or shared by people who are venture investors. It seems to me that in a fairly elevated market with some real questions on how the political outcome is going to be, what interest rates are going to be, that as an investor looking to make new investments, the thing to do is to focus on big changes in our economy and our society. And artificial intelligence or large language models may turn out to be a bit of a bubble. It may take longer for them to take over tasks from us as individuals or, in the workforces that we're involved in. But if you got 20 hours a week, let's say you're not a professional investor, you got 20 hours a week to concentrate on investing, I think you have to spend 10 hours out of the 20 focusing on artificial intelligence. And Tesla, given what they're trying to accomplish, is going to be part of that half of your time you spend on artificial intelligence, because I think we talked about this a little bit last Wednesday, and Jason might could get in more, but in effect, what he expects to do is to have these cameras, this information gathered, be collected in one place, and in effect have think of it as a language model that covers every roadway that any of us might possibly use. Jason, is that overstating the case, or is that the category of colonizing Mars, or how do you evaluate that?
No, I think that's exactly correct. When I think of artificial intelligence today, I think we're just building smarter, better software. I don't see it as like the singularity of the new intelligence. I think it's just better software. And to that effect, Tesla is absolutely going to have the largest data set of the real world, and they can categorize and describe and answer questions about the real world better than anyone else probably today. Google has their Google Street View, but they have to have special cars driving around, and they only have so many of them. But if every Tesla is on the road driving around, it's going to have a real-world daily view of what's going on. But it will be interesting how they use that data outside of automotive.
Mike, Jason's a little bit inaudible, or at least on my phone. Do you want to interpret some of what Jason's points are?
Let's start with the artificial intelligence. When it works, it's really just software. Now, Hunt, you made a good point that maybe the software, this artificial intelligence, will be better at things than humans are. But we've been developing technologies, and in fact, that is what technology is. Technology is the application of knowledge in a way that makes us better at things than we used to be. So whether you're talking about a calculator, which can do math better than you or I can do on our own, or a computer, or an artificial intelligence generative large language model, these are all just steps up a curve. And what we're facing today, as far as the fears and anxiety related to artificial intelligence, I think those are all the same fears that prior generations experienced with different forms of technology that change the way people live. Maybe the one difference is that these things are coming at us at a much faster rate than they ever have. So, that may be the difference. And then as far as Tesla's role in all of this, there's not a lot of companies that, and I guess Tesla included, that are actually generating free cash flow from selling products that are embedded with the latest versions of artificial intelligence. That's very likely to change in the future. And one of the key things that differentiates these companies is the data they use to train the models. And one of the best sources of data that Tesla has is the hundreds of millions of miles of driven in their Teslas and the videos that have been recorded on it. So they obviously use that to train the full self-driving piece of the car, which inevitably will drive the robo-taxi product that they're going to unveil in August. But they're also applying it to the humanoid robots that they're using in the factory, and how that actually translates from the real world video data into how it drives the actions of a robot. That goes a little beyond my capabilities, but presumably this type of information helps achieve some of these goals that Tesla set out to solve.
To get down to numbers, when we cite across page 1, these numbers have been updated for the first quarter of 24. Calculation of free cash flow, just citing from left to right, Apple's $95 billion, Amazon's $39 billion, Alphabet is $56 billion, Microsoft is $74 billion. I mean, no other companies come close to these kinds of free cash flow on the 20 pages of 60 companies or on companies that aren't on the 20 pages, and Tesla's 3. Now, these 4 companies, Apple's trading for, almost $3 trillion. Amazon's trading for just under $2 trillion. Alphabet's trading for just under $2 trillion. Microsoft is trading for $3 trillion. And Tesla's trading for, about $550 billion. We've talked about this before, but how likely is Tesla over a time period of 5 years to, when we cite across this page 5 years from now, how likely is Tesla to get to some number like $20 billion where it looks like it should be in the same company as these other 4 entities? And the interesting thing is that the company that probably is in the process of making the steepest incline in free cash flow seen ever is NVIDIA. I mean, I think NVIDIA has gone from 3 or 4 billion of free cash flow that at current run rates will be 35 or 40 billion of free cash flow, and they did it in record time. That seems to me, and their valuation is around 2 trillion, up 7 or 8 times. I can't see, I can see the case that Tesla can get to, say, 20 billion of free cash flow, but to do it in the next 25 years, to pick a time period, seems to me very tough. But once again, I'm really interested in drawing out you, Jason, and Mike. Is something like that feasible from Tesla?
I'll start. I think they'll have great progress on the path towards that goal. I think the more I think about the robo-taxis, the more I think that is going to turn them into a better cash flow generating machine. It's going to be much higher margin if they're matching rides to people that need them and not owning the assets. But at the same time, when I think about the robo-taxis, a big challenge for EV sales is they can't sell into markets where, say, people live in apartments or very rural areas and the like. You think the prototypical Tesla customer is going to be a suburban family, 2-car family, has a garage where they can install a charger. I think robo-taxis open up the market for Tesla to a much wider group of people. The urban apartment dwellers can have one, own one. It can drive itself to a charging station and park overnight, or generate money while becoming a taxi, and they can still own it and use it. So I think the autonomous vehicles and robotaxi specifically will be huge for the company, and maybe we start realizing that in 5 years.
Yeah, I don't disagree. I mean, aside from the tailwind that I suspect that there's going to be continued growth in EV sales over time. And as what we're seeing is that Tesla has a pretty definitive advantage over alternatives. Maybe one of the key enablers of additional uptake is going to have to be a cost-driven analysis. And if it is cheaper for people to own a Tesla, significantly cheaper than that of a gasoline vehicle, they're likely to be okay with the limited range and some of the other more difficult issues with owning an EV. I think moving toward a Model 2 is going to get you there, and even more so, the robo-taxi thing, if that's taking off in 5 years, that's going to give them, it's going to change the way that we do transportation. I mean, it'll be very realistic for a middle-class family to essentially have a private driver. And what does that mean? That means that they might not need 2 cars per household. They might need 1 car per household. So it does change a lot of the dynamics. That also means that you can charge a lot more for a Tesla than a competing option. And it gives Tesla plenty of opportunities. They've talked about licensing their full self-driving software to other manufacturers. Again, that'll be pure cash flow if they do something like that. So it's exciting, but again, like the 150 times free cash flow is never it wouldn't be considered a margin of safety, I think.
No. I will say, we've got a few more minutes. I will say, in reading the Tesla 10Q and the slides and looking at their approach to reduced volume, higher capital spending for these data centers they're putting in, they are awfully disciplined from a financial point of view. And the founder and chairman, CEO, whatever he's called, vectors off to talking about colonizing Mars, or whether or not the machines are going to have the upper hand on the humanoids. I think, oh my goodness, this guy is kind of the opposite of discipline. But when you look at the financial statements, in fact, they have no debt. They have more than $20 billion of cash on hand. They have had a significant decline in volume. They've been able to do a pretty good job holding their margins. This is a very, very financially disciplined business. We don't see the financials for SpaceX. I guess we don't see the financials for Twitter, X. But somewhere in that brain of his, or his way of organizing himself in these businesses, there is really good financial discipline, which is always good. Any closing remarks, Jason or Mike?
I just say, and Hunt and I have been talking about this in the mornings, is, obviously NVIDIA's so far been a huge winner from, if you actually look at the nuts and bolts of this artificial intelligence trend and turning it into cash flow. So the hunt now is for the next one. And it takes a combination of foresight and strategic positioning. So we talk a lot about Tesla, but there's others out there, and we keep turning those, looking at new ones to see what else could potentially be interesting. So those that are listening are welcome to participate, and feel free to email us if you find something really interesting, because we're always looking to look at new things. Okay, let's take a quick break for a message from Oak Cliff Sailing.
It's a beautiful day in Oyster Bay right now. And last night I was also in Central Park at the Boathouse. This is a painting that John Taylor did, and he's donated some of the prints for Rocking the Boat, which is a community sailing center. And that is part of the very beginning of what Oak Cliff has grown into. It was started before 2000 when we had American True. And as it's grown and grown and grown, we have at-risk kids coming to Rocking the Boat and other community sailing centers, coming to places like Oak Cliff to get jobs. Last night, Cole Brower was the featured speaker at Rocking the Boat, and there was this one girl. They came up to her and was like, oh my God. She thought she was going to faint when she met me. She was a little less, or met Cole, and she was a little less dramatic with me. But it's just indicative of what the important things are that we're doing with the different community sailing centers, with places like Oak Cliff, providing opportunities for people to go on and have really meaningful lives as leaders in the sport. So these are available for sale at Rocking the Boat at the Boathouse. And if you'd like to make a donation, you can always call us at 516-802-0368 or just go to the website, oakcliffsailing.org.
And now back to the show.
Absolutely. And the Apple Developers Conference, I mean, I think they got off to a good start. Mike and I talking in the morning, I'm sure Jason agrees, but I mean, their new iPad or MacBook, looks like they're doing a good job of trying to present those as you want to pay an extra $1,000 for them because they're going to be more able to deal with language models, which, Apple gets criticized for being slow to take up AIs compared to Microsoft, who made that deal with OpenAI or Alphabet, which has been, very active in this for more than a decade, or for that matter, Amazon. But it does seem, with the introduction of those two new products, that I would think that when between now and the developers conference, some of that gap, this perceived gap that Apple is behind on language models and whatnot, is going to be closed. Jason, is that something is that a thought you can subscribe to, or do you think they're still pretty challenged in terms of adapting to more emphasis on language models?
I'm kind of taking a wait and see approach. We don't have to wait too long, just another month. But the rumors are they've been partnering and looking for partners to develop the models, and software really generates a lot of their profits these days, or their growth as of recent. But we haven't seen the advancements in software, so I'm going to wait and see before I come to a conclusion.
Mike, you get the last word.
Apple has a lot going for it. They might be behind, but it probably doesn't matter. They've actually been behind on almost every product release they've done. You never say they were a first. I mean, there were cell phones far before the iPhone. What they are good at is doing things that are already out there better than what others do them. So they have, it's not the largest installed base for mobile operating system. That would be Android. But the users of iPhone spend a lot more money collectively than the users of Android. So software developers are more, there's just more of them that are angling for iPhone users. So I'm hopeful that Apple comes up with some interesting ways to exploit some of this technology on the phone. But they've been tight-lipped, and they always are pretty tight-lipped. And even the best Apple analysts out there don't have a lot of data on what to expect. So, the next month will be interesting.
Absolutely. In the meantime, everyone be well, stay healthy, and we'll talk next Wednesday. Take care.
The views expressed on this podcast are the hosts alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future and may or may not hold positions in the securities mentioned.